Is Europe back in recession, and what does this mean for my money? According to data, the European economy has already been shrinking in the past third quarter. And all the leading indicators signal that this shrinking of the European economy will continue in the coming months. This has, of course, some negative implications, like unemployment rate will increase, there will be more companies going bust during this time period, but don't underestimate, in a current situation where we want inflation rates to come down, this also has a positive effect for the central bank. European Central Bank has been bringing up interest rates a lot to combat inflation pressure. With the economy now weakening, even into a recession, the central bank is done hiking, in our view. So interest rates will probably have reached a peak now, will not go any higher, and the next large development will be interest rates coming down again, which is great for everybody who has to take up lending, who has a loan with variable interest rates. Here the interest rate should not get any higher, and in the medium term even fall back again. What does it mean if you have money to invest, like a savings account, something like that? With interest rates peaking, don't expect to get higher and higher interest rates on your saving account. Quite the contrary, as the probability is high that sometime down the road you will get less interest rates on your savings account, you should now, in our view, consider freezing this interest rate level for as long a period as possible. So have a talk, for instance, with your bank about fixing this interest rate level for a longer time period, or maybe even easier, you invest the money into a bond or a bond fund, which usually pays a fixed interest rate amount over the many years that this bond is active. What does it mean for equity markets? Well, the first half entering the recession is usually not so supportive for equity markets. Prices go down, companies have a harder time, the outlook for the companies is deteriorating. Pretty much what we have seen since summer with equity markets weakening. The point is though, usually around the low point of the recession, equity markets tend to bottom out, and with the outlook getting better for the economy, equity markets historically often have recovered quite fast. So either you have a crystal ball and can pinpoint exactly when is the low point of the recession, and then you go all in into equity markets, or if you don't have the crystal ball, well, what historically has worked well at least is that you use this time of weakening equity prices to gradually increase your equity exposure with a fund savings plan, or if you have a larger amount to invest in the equity market, that you split it over several time periods, and therefore make use of this better average buying opportunity, with the game, of course, to be well invested in the equity market in time for the next recovery with the economic outlook improving. Of course, we will try to keep you up to date when these might be, so don't forget to subscribe, ring the bell, and I wish you all the best. Until next time.